Good morning, everyone, and thank you for joining. We're going to let everyone continue to log on, and we'll get started in just a few minutes. Okay, it is 9:02, so we will go ahead and begin. Hi, everyone, and thank you for joining today's webinar. This will provide information on healthcare tax implications of the 2020 election. Today's program will be presented by Dan Mayo, Principal and National Lead, Federal Tax Policy. Before we begin, I have a few notes. Today's materials can be found on the toolbar on the right of your screen. Also, at the bottom of the toolbar, you will see a chat box. Feel free to send us your questions during the presentation. We will do our best to address them at the end. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I'm going to turn it over to Dan.
Great, thank you, Rachel. So we're here today. Get the slides going here. Great. So my name is Dan Mayo. I'm in the National Lead for Federal Tax Policy here at Withum. And today we're going to talk about some, hopefully not politics, but we're going to talk about tax policy. And so just want to have a quick note here that there is a difference between tax policy and politics. I'm going to try and keep away from any there'll be no comment, I should say, on the political views of Trump or Biden. I'm here to remain agnostic. I've done some of these webinars for in other venues, and sometimes you get very strident views from some people, and they take offense at summaries of candidates' positions. I'm here. My role today is to summarize the candidates' positions, but not to comment on whether they're appropriate or whether they're going to be effective in achieving the stated goal. So please keep that in mind. That I'm not here to present a view. I'm not here to suggest that one candidate is better than the other, and I will attempt to give equal time to both candidates' positions. So the agenda today, we're going to talk about sort of the current political landscape, where we are in the election cycle. Then I'm going to talk about the 2 candidates' proposals. I put Biden's first just because that represents a bigger change from the status quo, and I think more people are concerned, given that it would, if he wins, as is expected, if you believe the popular press, it's going to have a more significant impact on tax rates and people's taxes. Then we'll talk about, at the end, we'll close out with some year-end planning ideas. First, we're going to start with some healthcare specific planning ideas, and then get into general planning ideas. And if there's time, we'll talk about some gift and estate planning ideas, both election related and year end related. So we'll start with the political landscape where we are now. Everybody, I'm sure, knows the Republicans control the Senate with a majority, a three-senator majority. The leader of the Senate is Mitch McConnell, Republican from Kentucky. On the House of Representatives, it's led by Speaker Nancy Pelosi from California, the 12th District. So we do have a divided Congress and a Republican president. Elections are going to be in 7 days approximately, and it's November 3rd. The president, vice president, a good deal of Congress. The entire House of Representatives is up for election, as they are every 2 years. You contrast that with every 2 years, and they have longer terms. So instead of a 2-year term like the House, senators have a 6-year term. This particular cycle is the election in 2020. 23 of them are held by. So keep in mind, the Democrats don't need to win control, so they only need 3 seats, right? Because if there's a tie, then the tie vote goes to the vice president, as we'll see in a moment. As many of us know, mail-in voting is going to be significant. We're unlikely to have definitive election results on election day because of mail-in voting. And some states are allowing the ballots to be counted a day or two after election day. There's about 200 votes. So those are people over age 18 that are eligible to vote. More than 56 million people have already voted. There was an article the other day in the newspaper where I got that information from, and that's about 40% of the number of people that voted in 2016. So you have a fairly sizable amount of electors who already voted. Now, we don't know if the numbers of this cycle, 2020, will be greater than the 2016 cycle. So it may be that larger turnout this cycle. But they're expecting that 80% will have voted by election day. So, mail-in voting prior to election day. So the election's been underway for a while, and you have a sizable percentage will have voted before even election day. Joe Biden is leading, even in many swing states. Depending on the day, I give this web. His lead is greater than Clinton's lead was in 2016. We know how that worked out for Hillary Clinton. So the fact that the polls have him leading in many states, even in, again, swing states like Michigan, Wisconsin, Pennsylvania, Georgia, Florida, Texas, Arizona, doesn't mean that it's by any means a certainty. So on the Senate side, as we said, the Democrats need to win only 3 seats, and because if they have 3 seats, it'll be 50-50. It'll be a tie in the Senate, and the vice president votes. So that would fall to Kamala Harris if the Democrats win the election. So if that happens, they would have the House, Senate, and the presidency, which would lead to. We'll talk about what that means for tax policy on the next slide. The House is generally assumed to remain under Democratic control because of the number of seats that are up in the states. Well, not the number of seats, because of the makeup and polling and the bigger lead they have in the House. It's generally assumed that it's going to remain under Democratic control, and it's not widely believed to be up for grabs like the Senate is. So we'll sort of give a high-level overview of the candidates' positions, and we'll talk about some of the possibilities, and then we'll get into the details. So Biden, again, I'm summarizing here, is not trying to have engage in a political discussion, but Biden is going to, it's thought to have a moderate agenda, but he does have to contend with a party that has shifted to the left since the Obama administration. You have the Green New Deal and other progressive policies from senators that are thought to be on the left end of the spectrum. Now, Biden is unlikely to enact more progressive policy items unless Democrats take control of the Senate. Right, there will be that divided House if the Republicans keep control of the Senate and Biden wins. He'll have limited ability to pass a more progressive agenda. Some key issues to winning: Biden, COVID-19 cases remain elevated, the economy remains weak due to the again COVID-19, and he can attract manufacturing and unite the Democratic Party to get out and vote. On the Donald Trump side, he has a conservative agenda. But passage of that agenda depends on keeping control of the Senate, because without the Senate, and if he doesn't have the House and the Senate behind him, he won't be able to do very much other than continue the regulatory, passing regulatory rules in the form of executive orders and regulations. Keys to winning for him are strengthening the economy, reducing COVID-19 infections and the death rate, and managing a decline in the social unrest and the protests we've seen throughout the country. Some of the possibilities: what happens if control the House and the Senate? I think we're likely to see a very progressive agenda come out of the Democratic Party, perhaps one of the most progressive in U.S. history. Even in the debate last week, Vice President Biden said that he favored a transition from fossil fuels. He later walked that back, saying that what he meant was it would be over time. There's no ban on fossil fuels, but it would be a gradual shift away from fossil fuels into wind and other green energy. But if Biden wins the Democratic Senate, we have a divided Congress. With a split Congress, he won't be able to enact the more progressive policy items like healthcare and climate change. In this case, we would have a center-left presidency where I think major changes would be unlikely to occur. In this case, we should expect more executive orders and federal regulations like we're seeing come out of the Trump presidency today. On the other hand, if Trump wins, Republicans keep control of the Senate, but do not win the House as expected, we're really going to have the status quo, America First economic agenda. So I think that's that would be the status quo. Then if the last outcome, if Trump wins and Democrats control the House and the Senate, again, just the way the polling has come out, they're not expected to take control of the House, so thought to be an unlikely outcome. I put the slide in what happens to the stock market if Biden wins the election, or if Trump wins. So don't worry, markets will do fine regardless of who wins the election. I put some statistics here about what happens to the S&P performance if you have a Republican president, and then a couple different options on what happens with Congress, and same thing with the Democratic president. The key, though, is when you look at the average annual returns over a 70-plus year period, you see that they are positive in all cases. So the market is likely to do well regardless of who wins the election. Similarly, talk about tax rates. Even if Biden wins, tax rates, they would not be high by historical standards. And so you see this chart. I know it's somewhat fuzzy. I apologize for that. Rates have gone up, over the 50% range in the in the 70s, 60s, 70s, 80s, or 50s, sorry, 50s to 80s. And so rates were higher than they were, even if Biden does increase rates to 58%. Sorry, 28%, as he's been discussing. It's not likely to. It still won't be high by historical standards. And so I mentioned this only when we get to the plan more, but I mentioned this not to about long-term strategies for short-term changes in the tax arena. Again, we'll talk about a high-level comparison here. Let's start with Trump, President Trump. At a high level, what he was doing. TCJA, Tax Cuts and Jobs Act. Those tax cuts, many of them are temporary tax cuts because the legislation was passed under the budget reconciliation process, where they needed to meet a 10-year horizon. They had to consider the effect of taxes on a 10-year time horizon. So many of them are permanent. Many of them are temporary. He would make them permanent. He would reduce the capital gains tax rate further. We'll talk about that. The rate is, there's two ways to do that. He would reduce payroll taxes, although he's had limited support from that from Mitch McConnell and other members of his party. We'll talk about that as well. He would make, again, current rules permanent and freeze or reduce individual and corporate tax rates. Biden, on the other hand, would have a more selective rollback of the Tax Cuts and Jobs Act from 2017. He would increase the capital gain tax rate. He would raise payroll taxes on high earners, as he said many times in the press. Again, regardless whether you believe him or not, what he said is he will not increase taxes on the middle class, only on those high earners, which he defines at various times as over $400,000 a year or over $1 million a year. And we'll see the two contexts in which they rise. He would also increase the limitation on high earners and restore the SALT deduction, which has obviously greater impact on New York, New Jersey, California, the high tax states, than it does in the rest of the country. And he would raise individual and corporate tax rates. With that, I'll turn it over to Rachel for the first polling question.
Okay, thank you. So our first polling question is, who do you think will win the election? About 10 more seconds. All right, and I'll close it out, and here are the results.
Okay, can you still hear me, Rachel?
Yeah, there is a bit of, I don't know if it's wind or something in the background that's kind of picking up a little bit.
It might have been my situation. I tried to modify it. Did that make a change at all?
Yeah, right now it sounds pretty clear. I'll let you know if it gets a little choppy again.
Great, thanks. So on the poll news, we have who do you think's going to win? We have 55% Trump and 45% Biden. That's interesting. I guess that shows that the polls may not always be right, as they haven't been in the past. So, or we just happen to have a Republican audience today, a largely Republican audience. Either way, interesting poll results. So with that, we'll start now. We'll switch over to Biden's tax proposals, discuss them more in depth, and then we'll turn to, again, Donald Trump's proposals. So Biden's proposal here, he has no comprehensive tax proposal with all the provisions in one place, and technical details of his proposals are lacking, and that's similar to the Trump campaign. We don't see one document laying out comprehensive tax proposals for either candidate. I also want to keep in mind the tax proposals almost never materialize as advertised. So recall that the tax legislation begins in the Senate Finance Committee and the House Ways and Means Committee. So all taxing and spending legislation must arise there. So the president does not originate legislation. Obviously, he can influence it. So we tell people, don't panic. What you're seeing here are campaign promises / proposals. But that all the legislation is written in the Senate and the House, again, informed by what the president's willing to sign. Biden's tax plan, when it first came out, it was thought that when you add up all the provisions, it would raise over $4 trillion of revenue, obviously a significant sum, which scared a lot of people. I think a week ago, an organization came out with a revised figure that said when you add it all up, it's really going to be $2.4 trillion because of the pandemic, the way it impacts the tax policy. You can see that most of the increase on Biden's taxes would be on the corporate taxes, 1.3 trillion, as opposed to 962 billion on the individual side, and then a smattering of other things that where revenue would be increased. But we'll talk about the corporate income tax is relatively small as a revenue raiser in relation to the income tax, and we'll talk about that in a moment. I think I put a poll question in there so we can talk about it then. So Biden would raise the highest individual tax rate. It's currently 37%. He would return it to 39.6%, which is what it was before the 2017 TCJA, but only for taxpayers making more than $400,000 a year. So that's what he means as high earners in the context of raising the income tax. And it's interesting, when the IRS had a program recently and they talked about going after non-filers. They said they're going to go after high-income non-filers. And when the IRS used that context, they meant $100,000. So taxpayers making more than $100,000 a year. So when people say the high income, it's somewhat misleading because everyone has a different definition of what high income is. The IRS means over $100,000. In this context, Biden means over $400,000. He would phase out that 199A QBI, qualified business income deduction, again, only for taxpayers with income over 400,000. He would phase out itemized deductions for taxpayers with income over 400,000, and he would cap the benefit of itemized deductions at 28% of value. And so it's not clear what these things mean, right? A lot of this stuff comes from statements the candidates have made. It comes from limited policy pieces that have been issued. So there is a bunch of ambiguity to this, and it's not that I'm trying to be vague or haven't dug down into it. It's that the candidates like to keep the proposal somewhat vague because it's harder to criticize. Once they go into a very specific, clear proposal, it's easy for the other side to attack it and to really dig in and point out the flaws. He would also increase the Social Security portion of FICA. So he would increase the wage base. He would tax it to let me say it this way. Wages in excess of 400,000 would be subject to FICA. Right now in 2020, FICA, there's two portions of the FICA employment tax. There's Social Security, which is 6.2%, and there's a Medicare portion, which is 1.45. There's also an additional 0.9% Medicare surtax, but that's separate here. So what Biden would do is, right now, the Social Security portion of FICA, 6.2%, only applies to wages up to $137,700. That's scheduled to increase by a few $1,000s in 2021, but because of indexing, not because of either candidate's ideas. What Biden would do is he would apply the 6.2% Social Security tax to wages over 400,000. So, and it would be an unlimited cap like the Medicare portion is. So there's no wage limit on the Medicare portion, the 1.45. So that's what Biden would do here, but it's not clear what he would do on income between 137.7 and 400. I think what he's saying is it would not be subject to that Social Security tax. He's really trying to go after high earners, and that would be consistent with everything else he said, but it's not clear. And again, this is because they don't provide full transparency on the tax proposals. Neither candidate provides full transparency on the tax proposals. On the corporate side, the capital gain side and QDI, qualified dividend income, Biden would increase the rate of tax from currently 20% is the max rate. He would increase it to 39.6%, which is would be his maximum ordinary income tax rate for taxpayers earning more than $1 million in income. So if you have a taxpayer with significant income, annual income, they would no longer get the benefit of long-term capital gain rates for both sales of stock, for example, long-term capital gain, and also qualified dividend income, QDI, which came in 2003 under the Bush administration, Bush 2, W, the son. And so what this does is what Biden does essentially as a fourth bracket for capital gain and QDI income, and he caps it, and it goes up to ordinary income tax rates. He would also close unspecified loopholes that allow the super wealthy to avoid tax on capital gain. Not much detail around this proposal has been offered. With that, I'll turn it over to Rachel for a second polling question.
Okay, thank you. Our second polling question: which tax raises more revenue for the federal government? Corporate income tax, individual income tax, employment taxes, or excise taxes? About 10 more seconds. All right, I'll close it out, and here are the results.
Great, so it looks like 52% said the corporate income tax, 21% said the individual, and 28% said employment taxes. Yeah, I put this question in because I think this is interesting, and I don't know that I didn't have a full appreciation of this. Years ago, I attended a presentation and saw the stats. I'm sort of surprised at the results. When you look at those recent stats, and I'm looking at the 2018 results, the individual income tax raises about 6 times the amount of revenue as the corporate income tax. Pretty astounding. And literally more than 6 times the amount of revenue. So when you look at the changes to corporate tax rates, it's not causing significant changes to the revenue raised by the federal government. It's the individual side, which is why they need to really tax the middle class in order to bring in a lot of revenue. That's where the bulk of the revenue comes in. So changing the rates from a big picture view on the corporate side, it's not going to change the revenue that much. I think the numbers was 0.3 trillion for the corporate tax and like 1.8 or 1.9 for the individual income tax. So again, significant. And then employment taxes were less than the corporate income tax. Okay, so on the corporate tax side, what would Biden do? He would increase the maximum corporate tax rate from 21%, which is the current rate, to 28%.
Dan, sorry, can't see your screen.
Oh, you can't see the screen? I didn't do anything.
Hmm.
Can you see it now?
You cannot.
Huh.
Let's see.
Let me see. Oh wait, for some reason. Oh yeah, shut the sharing off for some reason. Let's try that. Can you see it
There
now?
we go. Yep, perfect.
Great. So Biden's tax. Thank you for that, Rachel. Biden's corporate tax proposals. He would increase the corporate tax rate from 21% to 28%. Recall that rates prior to 2017 with the Tax Cuts and Jobs Act, there's a graduated corporate income tax up to 35%. I think it capped out around 10-11 million was when it capped out to 35%. Now it's a 21% flat rate. Biden would increase that rate to 28%. He would also create a new minimum 15% tax on global book income on companies that earn more than 100 million of income. Again, book income, not tax income. He would provide tax credits to promote revitalizing, renovating, and modernizing existing recently closed facilities. He would expand tax credits to, again, to increase growth in domestic manufacturing. Again, when I say here, he would expect to turbocharge growth. That's the way his proposal was written. It's not me adding my editorial comments here on the effectiveness of these tax credits. So this is the same with Trump. I tried to keep language similar to what the candidates use themselves to give you a flavor of what the candidates said rather. So again, I'm not trying to editorialize here. He would provide 10% advanceable credits to companies that invest in manufacturing and also establish new incentives for companies to make critical new products in the US. He would increase the GILTI tax rate from 10.5% to 21%. This is a new tax on global intangible low tax income, GILTI, which came in as part of the 2017 Tax Cuts and Jobs Act. He would end many of the incentives that allow multinationals to lower the taxes on income earned overseas. He would create a clawback on benefits companies close in the US and send jobs overseas. Again, a lot of these proposals are really just talking points, and it's hard to get these types of things passed. And certainly, as we've talked about, legislation must originate in either the Senate Finance Committee or the House Ways and Means Committee on tax issues. He would create an offshoring tax penalty, namely a 10% on profits of companies that manufacture products offshore and sell them back into the US. He would eliminate certain incentives and penalties, impose penalties on the pharmaceutical manufacturers. Although now with COVID-19, they've been getting a lot greater press these days, pharmaceutical companies, and people realize the importance of allowing them large R&D budgets to create things like vaccines. So maybe the attack on big pharma might be mitigated a bit. He would also shift energy tax incentives to those clean energy jobs and deploy low carbon technologies. Again, that's what we saw in the debate when he said that he would shift away from fossil fuels, and then Trump said that's a pretty significant statement, and he admitted it was, although he later walked it back and said it would, again, it was a slow transition, no bans. He would repeal fossil fuel subsidies, I should say, not subsidiaries, typo there. And he would target the electric fuel credits, middle-class consumers and US-made vehicles, reinstate tax credits to reduce for residential energy efficiency, reinstate solar tax credit, expand. LIHTC is a low-income housing tax credit. So he would expand the low-income housing tax credit, new markets credits, and he would repeal the 1031 like-kind exchange rules, but possibly only for taxpayers with incomes over 400,000. The like-kind exchange rules apply only to real estate. They used to have broader applicability. They were significantly changed and limited as a result of the 2017 Tax Cuts and Jobs Act. So the like-kind exchange rules apply only to real estate currently. He would limit the investor's ability to use real estate losses, again, possibly only for taxpayers with incomes over 400,000. I think where this relates to sort of also what happened when Trump's taxes were revealed, at least the summary of them we've received from the New York Times review of his personal tax returns. I think we're likely to see, certainly if Democrats win the election, we're likely to see some sort of tax legislation, to get at the perceived abuses that were in Donald Trump's tax returns. I think those returns are likely to come to light eventually, and that Congress is almost certainly to pass some kind of laws to restrict the ability to not pay tax, which is what he did for many years. Although I'm not saying what he did was improper, but he looks like he had a lot of lost carryovers that just went many years into the future. And I think so there's concern about that, and thought that there's also concern that he might have aggressively used the rules. And so even though what he did may have been completely proper, which is certainly what he maintains, even if it was completely proper, I think the thought is they don't like the optics of that. There's likely to see some kind of limitation, perhaps to the passive activity loss rules, which is either the PAL rules, depreciation rules, and/or the NOL, the NOL rules, the carryover rules. Possibly the Biden campaign would tighten the opportunity zone regime to encourage affordable housability and job creation, so they would limit the ability of the Oz regime, perhaps by limiting the types of businesses, and that can be in there. Trump has proposed the opposite just the other day, saying he wants to expand the number of opportunity zones that exist. I think there's 7,000 or 8,000. I have it on a later slide. He proposes to possibly double that. So, big fan of the opportunity zone regime because it can eliminate tax for the investment in the opportunity zone if held for more than 10 years, among other things. It can also reduce or eliminate and defer capital gain currently. With that, I'll turn it to Rachel. Polling question number 3.
Thank you. Do you expect taxes to go up or down next year? All right, 10 more seconds. All right, and here are the results.
Oh, interesting. We have 87% said they expect taxes to go up, 13% expect them to go down. So I think if you combine this with the prior polling question, we had, I think 55% thought that Trump would win re-election. So the fact that I think we see such a high percentage of people think rates going up, perhaps that's because of the government spending, right? Because if Trump goes in, the rates are not thought to go up, they'd go down, as we'll see in a few minutes. So I think this might be a realization that because of the government spending during the pandemic, unrelated to Trump, it's not his fault, we have a pandemic, that the government deficit has been expanded greatly, and that we're likely to see increased taxes just to pay for what's been spent in the last year. So on the estate and gift side, Biden would tax unrealized capital gain at death, and this is pretty significant here, using ordinary income tax rates as discussed earlier. So he would eliminate the step up in basis at death, and this is one of the large, not loopholes, but features of the estate tax is that gain is not taxed at death. The estate is taxed on a gross basis, but not the built-in gain. So it's not clear whether you have a spousal exemption or if tax would be due at death or just take a carryover basis. So would it be taxed immediately or deferred until the heirs sell the assets? So there's, again, probably an intentional lack of clarity on how this would work, so to prevent detailed attacks from the Trump campaign. He would also reduce the lifetime exemption. It's currently 11.58 million. It's in 2020. It is indexed for inflation, so it will go up in 2021. There was talk about reducing it either to 5 million or to 3.5 million. Both of them were exemptions that were in effect before the Tax Cuts and Jobs Act, depending on the time, the year. So there is a talk about reducing the lifetime exemption. We'll talk about at the end of this presentation some planning ideas around this, how to take advantage of this large lifetime exemption before it is reduced, if in fact it is reduced. Also, Biden would limit the ability to take valuation discounts, such as lack of marketability. The other one is lack of control was the other significant discount, valuation discount that's often used in the estate context and gift context. On the retirement tax proposals, he provide tax credits for businesses that all employees have access to 401k plans. He provided refundable tax credits to equalize the tax benefits of defined contribution plans across the income scale. He would expand access to tax advantage ABLE accounts. ABLE accounts are accounts for handicapped, usually children, that parents can set up to achieve some tax benefits on savings for money that's going to be used to help their handicapped children. It's named after this. It's Achieving a Better Life Experience Act. It came in 2014. I think we had regulations in the past year or so, a couple of years. Starting to see the large brokerages really advertising and expanding the knowledge base on these ABLE accounts. Also allow additional hardship withdrawals for certain victims of domestic violence or sexual assaults. Recall there's also COVID-19 hardship withdrawal exceptions in 2020 that were passed. So we'll shift focus now. We'll turn to Trump's tax proposals, and again, less time is dedicated to this only because it's he's the sitting president, so it's more of the status quo. He is expected to double down on that Tax Credits and Jobs Act, or what he calls Tax Cuts 2.0. That was sort of one of the TCJA is one of Trump's signature achievements in office. He's very proud of it, talks about it often, and looking to sort of again double down on it with 2.0. The stated objective is to focus primarily on the middle class in the second round, although few specifics have been offered and revenue estimates are not available, particularly because few specifics have been offered. It's hard to give a revenue estimate for something without a clear plan of what it is. Again, I think that's intentional on the part of the campaign to prevent the Biden campaign from trying to poke holes at it. Various suggestions have been put forward, such as a 10% rate cut, capital gain tax relief. Two ways they talked about doing it, either by lowering rates or by indexing basis for inflation. So if you have, you can lower the rate, which reduces obviously the rate of tax, but if you index basis, you increase basis, you lower the amount of gain that's subject to tax. So it's a second way to get at it. There was talk at one point where Trump was going to try and, through executive order, increase the index basis for capital gain. And then I think there was significant pushback. They didn't have the legal authority to do that. So I know that is something he's very excited about, wants to pass. So I think there's a decent likelihood of some kind of capital gain tax relief, either rate reduction or indexing basis, to come in if Trump wins re-election. Again, Trump's a big fan of payroll tax cuts. His party's not, but he is. The party doesn't think they are an effective way to boost the economy. That's why they're against it, and there's no other reason than that. They just think there are better ways to juice the economy than the payroll tax cuts. Trump favors payroll tax cuts. He enacted that 4-month payroll tax holiday on August 8th by executive order. Industry widely shunned the tax holiday, did not enact it. At least that's certainly what we've seen and what you read in the press, that most large companies have decided not to do it. At the end of the day, when the IRS published guidance and the executive order, when you parse through it, it was optional. The employer had the control on whether they do it. It allowed for a 4-month tax holiday of the Social Security portion of tax, and then it had to be repaid in the first 4 months of 2021. Again, most companies decided not to do it, and much has been written about it. So he would also make permanent various tax rate cuts and other temporary relief that came in as part of the TCJA, as we talked about earlier. He would reduce corporate tax rates further currently from 21% to 20%. He would expand bonus depreciation by allowing full expensing for structures, not just for depreciable property. He would enact Made in America tax credits. He would expand opportunity zones. As I mentioned before, there are currently more than 8,700 census tracts. He proposed as recently as a week ago to potentially double that number and increase investment in developing communities. So that's the thought of opportunity zones and the hope that it spurs investment in economically depressed areas of the country. And then the census tracts, I believe, were designated by the governors. of each state. So the thought is they would double the number of zones into which investment can be made on a tax benefited basis. He would propose new tax credits for companies that bring jobs back from China. Also 100% expensing for essential industries like pharma and robotics who bring manufacturing back to the US. He would repeal several alternative energy tax credits. He would expand access to health savings accounts for Medicare beneficiaries. Recall HSAs are for taxpayers that have, or individuals that have high deductible health plans, and those plans are portable. HSAs are portable, so many employees use them as alternative retirement vehicles. There are limits on the amount that can be contributed each year, but there are many taxpayers, particularly our high-end or high-income clients, who establish HSAs and want to invest the maximum amount and have the value grow tax benefited over the years. But when they pay medical expenses, they use additional outside funds. So the HSA is used solely as sort of additional retirement account. So very great benefit if you have the means to fund an HSA but pay your medical benefits with other funds. Also, you would an advanceable child tax credit for new parents up to $5,000. So that's sort of it where we are on the two campaigns. Let's turn now to some year-end planning ideas and sort of where things are going, what you might want to think about as the year-end comes. And since this is a healthcare focused webinar, we're going to start with healthcare year-end planning ideas. So the first thing we have on the list is to maintain compliance with Section 501R, which requires tax-exempt hospitals to post certain information on their website and to review and update it annually. So make sure you have a plain language summary. Make sure there's a financial assistance summary, a billing and collection policy is clearly outlined on the website. There's a provider listing, and also the amounts generally billed, or what we call the AGB calculation. When hospitals, when hospitals report their community benefit costs on Schedule H of Form 990, we're saying make sure that you include and quantify pandemic or COVID-19 costs, including, right, you have the substantially increased PPE costs, education activities for the community and first responders. You have public health emergency costs and community mental health costs. So it's a matter of just getting the information right. Make sure you include it and put the maximum amount in there. The IRS issued this year new Form 1099 NEC for non-employee compensation. They also made changes to the 1099 MIS for miscellaneous income that are effective this year. So we're telling people to review and update your accounts payable function to make sure you accommodate these new forms. Also to review corporate structures for new entities, including joint ventures or partnerships, or they could be partners or corporations, but and for entities that are no longer needed, right, to rationalize the corporate entity structure, to try and identify tax saving strategies. And so year end is always a good time to see what happened over the year, assess, look at the corporate organizational chart, and see if you can rationalize entities, if there's a way to save taxes by combining and or restructuring the existing organizational structure. Last here we have is on the list is for specific healthcare items is to review and update the organization's conflict of interest questionnaire for federal and state reporting and disclosure. So just make sure that that is updated. And more generally, we talk about sort of election and year-end tax planning ideas. And so here, if you're on the business side, if you think the tax rates are going up, either because Biden is coming into office or because Trump's going to have to do something to increase the revenue to the federal government, given the massive spending that's taken place and the massive deficit spending that's taken place, so if you think rates are going to go up, you want to accelerate business income into 2020. Again, if rates do go up next year, the thought is that they would only be retroactive to January 1st, even if passed in, say, call it May, June, end of the year. They're not likely to make a retroactive to an earlier tax year. So if they're going to be retroactive, it most likely would only be to January 1st, 2021. So if you accelerate business income into 2020, you can get the benefit of low rates. So you would elect out of bonus depreciation, which would reduce your deduction in 2020, therefore subjecting more income to tax. You could trigger gain now instead of later, so accelerate sales of assets, exchanges, or distributions from a C Corp if you have the ability to control it. You might change accounting methods that would trigger increased income in 2020. Cash basis taxpayers, they can accelerate billings and collection efforts, so cash is received in 2020. That's when it's recognized for tax purposes, when it's received. Again, if you have a closely held company, consider how the company paid dividends in 2020. If they pay it earlier, in 2020, that's when it will be taxable. Also, if you're cash basis, you can defer the payment expenses. Expenses become deductible when paid. So if you simply pay that and pay an expense on January 1st instead of in December, you push off the deduction to the later year. What we do tell people, and I wrote an article about this on the Withum website in the last couple of weeks, I think, or maybe month or so. Don't let the tax tail wag the planning dog. And so we tell people, think in terms of accelerating something you're going to do anyway, rather than doing something completely foreign that you wouldn't otherwise do. So again, the expression, I didn't make this one up, it's been sort of around for decades, maybe longer. Don't let the tax tail wag the planning dog. And especially when you're thinking about accelerating income because of election year-end planning, try and limit yourself to things you would otherwise do. You're going to do anyway. You're just changing the timing. So we don't want people triggering a gain they were never going to trigger solely because they think rates are going up. Also, don't accelerate income if doing so will cause a reduction in other attributes like your 199A QBI deduction. So you do need to consider the knock-on effects of anything you do, because it could have, if it changes AGI, it could impact other deductions. So it should be a comprehensive strategy, not just think about one thing and say, let me do this. And you really do need to run the numbers, is what we tell our clients. On the personal income side, again, if you think rates are going up, you want to accelerate personal income, accelerate income into 2020. So think in terms of triggering long-term capital gain, which again, only long-term capital gain gets the max rate of 20%, not short-term. So if you trigger that in 2020 rather than 2021, you'll have income subject to that rate, particularly if you earn over 400,000 and Biden wins, the tax rate's likely to go up in 2021. How to do that? You can sell an asset, sell or exchange it today. In 2020, you could engage in a constructive sale transaction, which is section 1259. We don't want to spend too much time in the webinar going into this, but there are ways to trigger a gain without disposing of the asset. And one of them is a short sale against the box. I just put that here in case people are familiar with the strategy. There are certainly other ways to do it. You engage in what's called a constructive sale transaction. Slightly more complex, not for every taxpayer, but it's one of the options that are available to people. You could also ask an employer to accelerate a year-end bonus payment into 2020 so that it's taxable in the earlier year. Obviously, it's harder to do with a third-party employer. Easier to do in a closely held company environment. An employee could exercise stock options or make an 83B election on deferred comp. That's subject to some kind of restriction to bring that into income in 2020. You can convert an IRA to a Roth. So if you can convert your pre-tax retirement accounts to an after-tax Roth account, that would also trigger income, and the income would also grow for the future. In the Roth, it would be tax-free. Obviously, Roth IRA is better than a non-Roth IRA once it's established, because it's not subject to additional tax like a traditional IRA is. If you're over 59 and a half years old, you can consider taking a taxable withdrawal from a retirement plan without penalties. Alternatively, if you don't think rates are going up, you think they're going to go down, do the opposite of everything I just said. And so you'd want to defer income if you think rates are going down, you would defer income away from 2020 and into 2021. The general rule with year-end tax planning, usually the general rule is to defer income and accelerate expenses. This is independent of an election year. So independent of what you think is going to happen. If you think rates are going to remain static, the general rule would be to defer income and accelerate expenses. So if you still want to do that, you're saying, I don't want to think about the election, it's too speculative on what's going to happen to tax rates, you might engage in this general year-end planning, which is to defer income and accelerate expense. On the deferring income side, what could you do? You could do a like-kind exchange, a 1031 exchange of real estate. We talked about that earlier. So since 2017, the Tax Cuts and Jobs Act, the like-kind exchange provision applies only to real estate. You could invest your capital gain into an opportunity zone. There are sort of three main benefits of investing in an opportunity zone. One is you get to defer the capital gain that you invest into the qualified opportunity fund. Two is you can eliminate some of that capital gain up to 10 or 15%, depending if you meet a 5 or 7 year holding period in the qualified opportunity fund. And three, perhaps the most significant benefit is you eliminate 100% of gain in the opportunity zone investment will be eliminated if you hold it for at least 10 years. So that's I think the most significant benefit of an investment in opportunity zone. The third here, you can, if a taxpayer has a recognized gain from qualified small business stock, 1202, section 1202, that gain can be rolled over into other stock, and the gain can be deferred. So that's section 1045, a rollover of qualified small business stock. And that's a significant way to again defer gain by rolling it into other qualified small business stock. Installment sales are always a way to defer gain until payments are received. So if you're selling a business, either the assets or selling stock of a business, you can engage in an installment sale transaction where you receive money over time, and that will defer the recognition of gain. And then also contribute to a health savings account, as you mentioned earlier, three times tax benefits by investing in an HSA. The limits here are in 2020 are $35.50 for an individual health savings account and $7,100 for a family account. If you're 55 or older, you can make a catch-up contribution of $1,000. Again, many of our clients use these as additional retirement accounts and fund their health expenses with funds outside of the health savings account because it's a portable account, and you can invest the funds in mutual funds. So you can invest the health savings account and really manage it like an additional IRA. If you wanted to, again, independent of election planning, you could accelerate expenses into 2020 to reduce your tax burden in 2020. And so some ways, the biggest way to do this is to bunch your itemized deductions. Prior to 2017, you had a choice of itemizing or standard deduction, but the standard deduction was so small, it was easy to itemize. It's much harder to itemize now because the standard deduction has gone up so much. It's like, I think it's 12 or 13,000 in 2020. So you really need to bunch your itemized deductions into a year in order so that your itemized deductions are greater than the standard deduction. So how do you do that? You can date and mail checks in 2020 to accelerate those expenses. So if you're contributing money to a charity, you can write the check and mail it in 2020, or you can deliver cash in 2020, and you can use credit cards to make payments. That counts as a payment for purposes of itemizing deductions. Normally speaking, when you promise to pay someone, that doesn't make an expense deductible. You have to actually pay it. When you pay with borrowed funds, that is considered a payment for tax purposes. You can contribute money to a donor advised fund today and allocate the funds later. So with the donor advised fund, you contribute money to a fund now, and you don't have to allocate the funds, the money you donated to any particular charity. You can do that in time in the years to come. So, but if you're expecting, for example, to make $1,000 contribution each year for 5 years, perhaps you make a $5,000 contribution in 1 year. So you can bunch up your expenses and then allocate them over the next 5 years, $1,000 a year over the next 5 years. You can do that with a donor advised fund. Also double up on charitable contributions every other year. Similar to what I just mentioned, if you're going to contribute $1,000 a year, perhaps you contribute $2,000 1 year, skip the next year, and then bunch up again in year 3. So by bunching up those charitable contributions, you can hopefully get your itemized deductions to exceed your standard deduction. You can prepay some mortgage interest in 2020 that's due in January 2021. You can't do the whole year, but you can certainly do the next month. And so prepaying some of that will get you will bunch the deduction into the 2020 tax year. Similarly, with your estimated tax payments, you can pay them a little bit early in 2020. Your state tax payments, again, there is a cap. Remember, there's a $10,000 state and local tax limit that was imposed in 2017. So you can only do that up to that $10,000 cap. And then for C Corps and S Corps, what we advise people here is there's competing and opposite considerations for C and S Corps in terms of what's reasonable compensation. In an S Corp, what you want to do is the typical strategy with an S Corp is to minimize compensation to the owners and maximize distributions of profit to the owners, right? And so because employment income is subject to employment taxes, but the distribution of profit is not subject to employment taxes. So this is something I talked about Trump and his tax returns and how he was criticized. This is something Biden was criticized for. He, I think he earned $3 million of income from, I forget if it was speaking or book royalties, something. And he had it held in an S Corp, and he declared, I think it was something like, I'm going on a recollection here, many years back, 300,000 of income. So his income, his employment compensation was about 10% of the total profit in the S Corp, is my recollection. And that's what he thought was reasonable compensation. And so you minimize the employment taxes. But however, when you switch to a C corporation, the incentive is to do the opposite. And because there's a double tax that applies to C corporations as opposed to S Corps, when you're in the C Corp environment, usually owners want to maximize compensation to reduce that double tax. They're willing to pay the employment tax because it reduces the corporate tax, the second level of tax. So in the C Corp context, usually smaller businesses want to maximize compensation to zero out the income in the C Corp, so it's not subject to double tax. So I'll turn it over to Rachel now for our fourth and final polling question. And then after that, we'll turn into some estate and gift tax planning ideas.
Thank you. Do you plan to talk to your tax advisor regarding year-end tax planning ideas? All right, 5 more seconds and I'll close it out. Okay, so here are the results.
So it looks like 53% said yes, 47% said no. It seems fairly evenly divided. Since this is a tax policy webinar, we'll say the margin of error is probably 3% in this poll at least. So it looks like 50-50, close to 50-50 in terms of talking to tax advisor about year-end strategies. Okay, the final slide, and then if there are any questions, we can address them, is estate and gift tax planning ideas. We talked earlier, there's a $11.58 million lifetime exemption for gifts that exists in 2020. It's going to go up in 2021. It's indexed for inflation. And that exemption, the thought is if you use that up today, you will not be clawed back. So you would be able to use it up in 2020, even if it goes away in 2021, or eventually it's going to sunset in 2025, the higher exemption amount. If they reduce it next year, say to 5 million or 3.5 million or even less, they won't claw that back. So you can still give away 11.58 million per person in 2020, and that would be a permanent lifetime exemption, even though the amounts are reduced if they were reduced next year. So what are some of the ways to give away funds if you are inclined to take advantage of the lifetime exemption and not pay gift tax in 2020? You could give a loan to a trust or family members, and then either you could forgive that loan, which would give rise to would be a gift. The release of the forgiveness would be the gift. It would be a gift, not COD income, because it's you're giving it as to a family member. There's a donative intent there. You could also make gifts to defective grantor trusts. And when we talk about defective grantor trusts, we say they're intentionally defective, by the way. It's not as if it's a mistake. The trust, when you transfer the money to the trust, you create the trust in a way so it's effective for estate tax purposes, but not for income tax purposes. So with these defective grantor trusts, when you give money to the trust, you get it out of your estate, but you pay tax on it. It's to treat it as a grantor trust for income tax purposes. So you can still pay the income tax without triggering the gift tax. So it's an effective way to still pay tax on income, yet get it out of the estate to use up that 11.58 million lifetime exemption. Similarly, sales to defective grantor trusts can be used to freeze estate tax valuations. Also, use valuation discounts to the extent you think they're going to disappear to leverage use of the exemption. So, right, discount for lack of control, lack of marketability. Also, when you think about which assets to gift, we talk about you gift assets or investments have the potential to increase in the future. Again, the higher the asset appreciates in the future, the more it remains in the estate, and no future gift tax will be paid. So all things considered, you'd rather give stock that's likely to appreciate to your children rather than stock that's likely to remain flat, because the future appreciation can escape the gift tax and the estate tax. You'd also want to trigger long-term capital gain now at current preferential tax rates to increase your basis rather than wait for the step up at death, which may be repealed. So that's another option to consider. Also, consider the use of charitable remainder and charitable lead trusts. Again, a way to maximize charitable giving. And finally, the last idea I'll mention, I know we have about 30 seconds left, is creation of a dynasty trust to utilize your generation skipping tax exemption. In case of if they limit the rule against perpetuities, you can create a dynasty trust to give funds to multiple generations and to utilize the GST exemption amount. So that concludes our presentation. I see there are no further questions. So thank everybody for joining. Hope you learned something useful on the webinar. Feel free to reach out to either me or to your normal Withum contact if you have questions or would like to discuss year-end planning ideas. Thanks again, everybody.
Thanks, everyone. Have a great day.